Good morning, everyone. You are watching a live market outlook for Tuesday, 24th of January 2012. Positive sentiment continues to move the markets higher, despite some setbacks seen late yesterday and overnight after unexpected, I would say, failure in Greek debt negotiations and restructuring. Suffered another major setback. The euro was lower down to some initial support levels where the temporary ground was found, and it continues rallying higher. Similar with the sterling that tested yesterday some key levels at 156, while the dollar remains lower across the board, except against Japanese yen that currently moves within a narrow range and in directionless mode. Gold is again gaining strength after hitting a fresh high of 1681, pardon, yesterday, and holding above some strong support levels, while the crude oil remains still under pressure, currently attempting as a recovery from yesterday morning is still underway and facing some difficulties at this point. More of this will come in our technical part. Now let's see what was the release of yesterday's Eurozone finance ministers meeting. Actually, it's going on today also. The finance ministers basically rejected as insufficient an offer made by private bondholders to help restructure Greece's debt, sending negotiators back to the drawing board and raising the threat of Greek default. At a meeting in Brussels yesterday, ministers said they could not accept bondholders' demands for a coupon of 4% on new longer-dated bonds that are expected to be issued in exchange for their existing Greek holdings. Banks and other private institutions represented by Institute of International Finance say 4% coupon is the least they can accept if they are going to write down the nominal value of the debt they hold by 50%. Greece says it is not prepared to pay a coupon of more than 3.5%, and Eurozone finance ministers effectively backed the Greek government's position at Monday's meeting, a position that the International Monetary Fund also supports. The chairman of Eurogroup, Jean-Claude Juncker, said Greece needed to pursue a deal with the private bondholders where the interest rate on the replacement bonds was clearly below 4%, stating the ministers asked their Greek colleagues to pursue negotiations to bring the interest rates on the new bonds to below 4% for the total period, which implies the interest comes down well below 3.5% before 2020. We'll keep following closely the developments with the further negotiations between Greece and the Eurozone finance ministers to have some more information whether the agreement will be found or the worst scenario would be likely at this point. More pressure comes after yesterday's sanctions imposed by Eurozone towards Iran, as Iran accused the Europeans of waging psychological warfare after the EU banned imports of Iranian oil, and US President Barack Obama said Washington would impose more sanctions to address the serious threat presented by Iran's nuclear program. The Islamic Republic of Iran, which denies trying to build a nuclear bomb, scoffed at efforts to choke its oil exports as Asia lines up to buy what Europe scorns. Some Iranians also renewed threats to stop Arab oil from leaving the Gulf and warned that they might strike US targets worldwide if Washington uses force to break any Iranian blockade of strategically vital shipping route. Yet in 3 decades of confrontation between Tehran and the West, rhetoric and the undependable armory of sanctions have become so familiar that benchmark Brent oil price edged only 0.8% higher, and some of that was due to unrelated currency factors. Yeah, this is also significant that oil price is still under pressure, and overall the wider picture shows that the price is still going lower despite such a serious threats of possible conflict in the region. But yesterday's replacement of the aircraft carrier of USA, when one finished and the other one came without any problem moving through the Strait of Hormuz, seeing that the situation is so far calm, except the heavy rhetorics that are going around. From today's calendar, quite busy day. During the night, we had release of the Japan monetary policy that the Bank of Japan kept it unchanged at 0 to 0.10%. French manufacturing PMI came this morning. German flash manufacturing PMI is due at 9:30 GMT, so in approximately 15 minutes. Forecast for today 49.1 versus 48.4 previous month release. German flash services PMI is due at the same time. 52.6 is today's forecast, better than 52.4 previous month release. Eurozone break. Eurozone flash manufacturing PMI due at 9 o'clock GMT. Forecast for today 47.4 versus 46.9 previous month release. Eurozone flash services PMI at the same time 49.1 forecast versus 48.8 previous month release. Public sector net borrowing from UK due at 9:30 GMT. Decrease to 12.4 billion pounds is forecasted for today compared to net borrowing of 15.2 billion pounds in the previous month release. Eurozone industrial new orders monthly release due at 10 o'clock GMT. Decrease by 2.1% is forecasted for today compared to raise of 1.8% of the previous month. Across the ocean, Canada retail sales due at 13:30 GMT. Monthly release forecast for today 0.3% up compared to growth of 1% in the previous month release, while core retail sales are expected to grow by 0.2% compared to growth of 0.7% previous month. Richmond manufacturing index from US due at 1500 GMT. 6 is the forecast for today compared to 3 at previous release. Let's now take a look on the technical part to see the latest developments in the markets. As mentioned, euro remains steady after hitting yesterday, after breaking 130 psychological barrier and hitting a high at 130.51 when some corrective pullback was seen mainly due to negative news from the meeting of Eurozone finance ministers with the Greek officials. However, the technical support at 129.84 previous high of last Friday offered a good support and contained the dips where the floor was found at 129.87, with the pair now again heading higher, holding currently above 130. Hourly studies are slightly losing momentum. However, the wider picture on 4-hour holds the positive tone despite overbought conditions. Potentially seen for further gains and the test of the next key barrier at 130.75, 130.80. high of until now of 2012 posted on 3rd of January, and 50% Fibonacci retracement of the down move from 135.47 down to 126.22. A break here is required actually to confirm the short-term positive structure to erase the latest down leg and open way for a further extension higher, where we have 131 and 131.45 low of 4th of October 2012. For now, the gains look like will be capped at this point, as the overall downtrend remains dominative for the euro dollar, and this is the top of the latest down leg that was moving down from end of December down to beginning of to middle of January, when it hit fresh low at 126.22. On the 4-hour chart, we can see that as mentioned, that the trend is still unobstructed. At 20 days moving average offers dynamic support currently at 129.46 and is maintaining the current uptrend, as yesterday's Friday to yesterday stronger pullback was contained also by 20 days moving average. On the downside, the immediate support at 129.87 low of today posted overnight, while only loss of 128.75, the break point, previous high of 13th of January and low of yesterday, would soften the short-term tone and likely confirm the temporary top at levels above 130 in favor of stronger reversal and possible resumption of the broader downtrend of euro-dollar. Cable is in the corrective, near-term corrective mode after hitting yesterday one of the key barriers at 156.00. This also marks 55 days moving average on the daily chart. However, the pair was unable to break higher, so some correction was seen following the latest rally. 155.36 was seen so far, ahead of strong support zone at 155.15 low of yesterday, and 155.00 previous strong resistance now reverted to support, above which, holding above which and reversal above which is required to keep the short-term uptrend intact for further extension higher. Holding above 155.15, where also comes the 20 days moving average on 4-hour chart that maintains the latest rally, sees potential for further extension higher and above 156.00. That is the high of yesterday, to open next significant group of barriers. 156.68 are the highs of 3rd and 4th of January, also highs of 2012 until now. Also dynamic barriers, 90 days moving average on the hourly chart at 156.55 currently, and the main bear trend line drawn of 166.17, high of 19th of August 2011, currently standing at 156.67. So for a stronger recovery of cable, we need to see break above first of all 156 and then 156.60-80 zone. That would signal a stronger recovery, and then open way towards the next barrier at levels at around 157.70. This is the end of November to end of December consolidative range ceiling, above which would confirm the bottoming at 152.33 and allow for a stronger movement, and basically will bring the pair back into the broader range that is defined by 152.30 and 161 zone on the upside. On the near term, supports at 150.50 36, 155.15 and 155.00 as a break point and the key near-term support. Further down, 154.50 comes next ahead of 154 zone in case of break. Dollar yen is currently near-term price action moves within a narrow range in the directionless trading, hovering around the 77 zone after an unsuccessful attempt higher to clear 77.30 strong barrier where 90 days moving average on daily chart still caps the upside as 19th of January, 19th and 20th of January rallies higher stalled at the same level hit beginning of January at 77.32 and subsequent reversal has so far found support at 76.85, one of our supports, just ahead of 76.65 and 76.50, the key support for dollar yen for now. Holding above 77 that the pair is currently attempting to break higher will keep near-term and short-term sort of positive structure for possible retest of 77.30 to open way for a stronger recovery with the 77.50 and 78.20 significant barriers to come next for test. As we can see, the 90 days moving average is still cupping. The next dynamic comes at 77.39 along with the 77.32, which is 55 days moving average, to open way towards 78 and 78.21, the previous November to December consolidative range ceiling that will signal stronger recovery. However, our daily outlook maintains still a rather negative tone as the pair holds below 55 and 90 moving averages and keeps the tone slightly skewed towards the downside with the focus at 76.50 to avert immediate downside risk clearance of the previously mentioned levels 77 and 77.30 is required. Otherwise, the risk remains for retest of 76.50, loss of which would threat full retracement of October's post-intervention rally from 75.56 to 79.52, with the first support to come at 76.10, 76.00 ahead of a record low of dollar yen at 75.56. The dollar Swiss near-term price action sees the consolidation of the heavy losses that the pair suffered during the past week after an unsuccessful attempt to clear 96 barrier, with the double top left at 95.73 on the 13th and 17th of January. Loss of 95, then 94, and the 93 supports. Especially significant is 93.00, where the pair broke below 55 days moving average on the daily chart. Extended so far to 92.50, the low of yesterday, with the current consolidation underway, but still holding below initial resistance at 93.00 that now acts as resistance, previous strong support. A negative tone persists on the lower time frames, keeping the downside in focus with the break below 92.50 to open next support close to it, 92.42 low of 21st of December, ahead of Fibonacci level of 38.2% of 85.66 to 95.93 at 92.00, and dynamic support 90 days moving average at 91.70 that technical traders are likely going to put as they are already put, I suppose that's their target, as the pressure remains on the downside. A break below the center lines on the daily studies also signals further reversal of the dollar Swiss and further retracement of the broader uptrend from 70.67 record low of the pair posted 9th of August 2011 up to 95.93 high of 9th of January 2012. From commodities, we are in the 4-hour chart of crude oil. We can see that the pair is still under pressure of 103.72, a peak of 5th of January, with continuous descendant series of lower highs and lower lows, keeping the short-term tone turn towards the downside. The latest low posted on yesterday, that 97.43, with recovery attempt now attempting to clear 4-hour 20 days moving average, currently standing at 99.93. Also attempting to clearly break $100 per barrel as our initial and psychological barrier. So far 100.22 was seen, but still no signals of clear break, with the lift above here. Also the 20 days moving average to signal some stronger recovery. Open next level at 100.86, and then 101 ahead of next significant supports at 102.22, tops of 18th and 19th of January. Above this trend line resistance comes at 102.39, so it's a strong resistance zone at this point. Failure to clear 100 to clearly break 100 risks further reversal, with the threat of leaving another lower top at 122 for possible extension lower and test of previous low at 97.43, with interim support at 97.92, low of 13th of January. On the daily outlook, positive tone still persists as pair broke. The oil price broke above 99.05 55 days moving average, with the next dynamic resistance at 100.63 20 days moving average required to be cleared in order to resume higher for test of levels at 102.22, 103.39, and the key barrier at 103.72. Loss of 97.42, yesterday's low, would risk further reversal and a possible test of levels at 94 and 98, low of 25th of January, and next static support and the key short-term support at 92.70, 16th of December 2011 low. Yellow metal, after breaking some significant barriers, also the main bear trend line drawn of 1920 record high, posted fresh high at 816.81.60 in late hours of yesterday, ahead of subsequent consolidation that is still holding above 1670, and this is above 1670, which is our next significant support. Holding above this level keeps the immediate focus higher as the gold price currently hovers around 20 days hourly moving average. On the 4-hour chart, the situation is more positive as studies are still in the positive field, and while 1670 and 1664 dynamic support of 20 days moving average contains the downside, scope is seen for further extension higher. For now, the bear trend line, broken bear trend line, contains dips, as there was no clear break here, with the sustained gains above these levels to focus next once at 1700 as a figure resistance, and 1756 and 1763 the static resistances levels of 2nd of December and 8th of December 2011. On the downside, risk will be on loss of 1645 and 1642 200 days moving average. That might further weaken the longer term structure as the pair remains in the downtrend from 1920 6th of September 2011 record high, and the failure to clearly break the trend line, also the 55 and 90 days moving averages on the daily chart would risk lower top and further reversal. The daily outlook is still positive, with this obstacle still not seen as with clear break higher still not seen, and we have to watch closely. If the pair regains 1700, that we might see it retesting levels at 1756 and 1763. Otherwise, risk remains for further consolidation. But while the 1642 200 days moving average holds, that will be seen as consolidation. Otherwise, it risks a fresh leg lower, and the lower top at level set around 1681, where the yesterday's high was posted.